One way scammers manipulate the stock market. You think you're investing just like everyone else, buying a few stocks, maybe a little cryptocurrency, and hoping they'll rise in value over time. But what if I told you that somewhere out there, someone already knows your next move, even before you hit the buy button? And sometimes they're not just ahead of you. They take everything you've got. Imagine this: a flashy finance guy promising easy money, throwing cash around like the market could never crash. But when the truth comes out, FBI agents storm into his office, and angry victims flood the streets protesting. You've probably seen stories like this and wondered what really happened. In this video, we're going to break down the biggest scams in stock market history, how they work, how Wall Street turns loans into gambling, why it keeps happening, and most importantly, how you can spot them before they spot you. All right, let's get started. Part 1. How these scams usually unfold. The truth is, market frauds rarely happen randomly. They often follow the same pattern, even when the details look different. In the stock market, an insider is someone with privileged information or access to a company's internal data or shares. They're usually the masterminds behind these kinds of schemes, like this. So everything always starts with hype. An insider needs a story that convinces people this is the opportunity of a lifetime, something too good to ignore, or a guaranteed path to wealth. That excitement is the bait. Once you're hooked, the next step is control. Sometimes they control the actual supply, making people think the stock is scarce, so you rush to buy it. Other times they control information, making sure you only hear good news so you keep buying more. As more people buy, they start competing. And that competition pushes the price higher to ridiculous levels. And that's when the insiders strike. They sell their shares, while the rest of the market is still buying. When people finally realize what happened, the competition reverses. Now everyone is trying to sell, and the latecomers are the ones who lose the most. So is it illegal sometimes? Yes. But other times, it's done through loopholes in the law, making it completely legal on paper, even though it causes the same damage. That's why legendary investor Warren Buffett always says, never invest in a business you don't understand. Part 2. Amazon, from cheap stock to meme cryptocurrency. Pump and dump is the classic form of stock fraud and one of the simplest in stock market history. Take Jordan Belfort as an example. The real-life Wolf of Wall Street, one of the biggest fraudsters in U.S. financial history in the 1990s. He made millions through a scheme called pump and dump. Here's how it worked. First, his team used Zodiac houses, secret operatives, to buy shares of small companies that were little known. Why in secret? Because if people saw him buying in large volumes, the stock price would rise too early, and everyone would realize something was off. Once they had bought enough shares, his brokers started calling individual investors the stock as if it was about to skyrocket, as more people bought into the story and rushed in. They competed for the limited shares, driving the price up. And that's when the insiders struck. They sold all their shares at the inflated price. But once the selling started, the stock price plummeted quickly. The last buyers, the latecomers, lost the most because they bought at the peak, just before the market crashed. And the point is, this wasn't just a scam with cheap 1990s stocks. Today, it shows up in Discord or Telegram groups. Hype unknown stocks, sometimes called Tesla stocks, or cryptocurrencies that skyrocket overnight. Names may differ, but the pump and dump script remains the same. Part 3. The insider trading advantage. In the 1980s, one of Wall Street's biggest scams involved Ivan Boesky and Michael Siegel. Boesky was an investor who made huge profits by buying shares just before companies announced mergers or acquisitions. Just before mergers or acquisitions. Take Metro buying Nations as an example. When a big company like Nelson wants to acquire Nations, they have to buy 100% of the shares, including the shares held by individual investors, to convince shareholders to sell. Nelson usually offered a pre-carnation stock jump as soon as the deal was announced. At that time, Manchester worked at Kidder Peabody. as an investment banker involved in financing many upcoming deals. So he often knew this information before the public did. Boesky then paid Siegel consulting fees, which were really bribes, to leak insider information. Thanks to these tips, Boesky bought Nation stock at around $60 or $70 when the news was announced, and Nelson's acquisition offer pushed the stock above $80. Boesky pocketed $28 million. That was insider trading. And this is why this behavior is illegal. If you know something that will make a stock rise before everyone else, you can buy it low, then sell it high and profit, while others pay more. It's like getting the test answers a week in advance. You memorize them, while everyone else is still struggling. A week in advance, you've memorized it, while others are still struggling and failing. That's why many Americans suspect that lawmakers might know bills or policy changes before they are enacted, things that could affect the stock price of a company. For example, if Congress is secretly discussing a new law to grant billions in subsidies to clean energy companies, then a politician could buy shares of solar panel solitaire or electric vehicle manufacturers before the law is publicly announced. Once the law is announced and regular investors rush to buy, the stock price surges, allowing early profits. Because of situations like this, politicians, along with executives and major shareholders, are required to disclose their trades. Tracking these reports can give you clues about what insiders think will happen next. In reality, there is a new investment trend called the Pelosi Tracker, which tracks publicly disclosed trades of Nancy Pelosi, former Speaker of the U.S. House. The idea is, by copying investments of prominent lawmakers, you can benefit from the same market movements they create. However, this data is usually released several days, or even weeks after the trades actually occur. So some argue you may already be too late to catch the largest gains. 4. Always do your own research and understand the risks before making financial decisions. Part 4. Systemic scams where the whole market participates. Sometimes, the scam isn't just by an individual or a company, but the entire system plays a dangerous game. This happened in the 2000s, before the 2008 financial crisis. In the U.S., commercial banks such as Countrywide issued mortgages to almost anyone, even those with unstable income. Normally, the bank would hold the loan for 30 years and earn interest over time. But they didn't want to wait decades, nor take the risk if the borrower defaulted. So they sold the loans to Wall Street firms like Lehman Brothers. For example, let's say John borrowed $100,000. Countrywide charged multiple fees like origination fees, processing fees, and document fees. These fees were their profit. Then they sold John's mortgage to Lehman for $100,000. So Countrywide got the money immediately. John still paid Countrywide. They might keep a small fee, but most of the money went to Lehman. If John defaulted, that was Lehman's problem, not theirs. But Lehman didn't want to hold individual loans either, so they bundled thousands of loans together into a financial product called a CDO, short for collateralized debt obligation. A debt obligation backed by collateral. CDOs were basically a bundled meal containing multiple loans, safe, some risky mixed together. To sell these bundles, Lehman needed investors to trust them. So they turned to credit rating agencies like Moody's and Fitch. These agencies were paid by Lehman to label many CDO packages with an A rating, the highest safety level. This is how Wall Street turned loans into investment products. Just like stocks, investors saw the A rating and thought it was as safe as government bonds and poured billions into it. Suppose Bob bought a CDO slice worth $10,000. John repays Countrywide. Countrywide keeps a small portion and passes the rest to Lehman. Lehman takes their cut and sends the remainder to Bob. But Wall Street didn't stop there. They created another type of bet based on these loans called CDS, credit default swaps, or credit risk swaps. In theory, CDS acts like insurance for CDOs. But in reality, it was more like gambling on whether the loans would fail or not. For example, Rex bought a CDO slice worth $10,000. A company like AIG sold him a CDS insurance contract Some investors like Bob already knew these CDOs were risky because many borrowers like John couldn't actually repay. So Bob agreed to pay AIG a monthly fee. If John's loan defaulted, meaning the CDO failed, AIG would have to pay Bob the full $10,000. If John repaid successfully, AIG just kept Bob's monthly premiums. It worked just like life insurance. If you're sick, the insurance company pays treatment costs. If you're healthy, they only keep your monthly premiums. The same principle applied here. And here's the craziest part. AIG didn't just sell contracts to one person like Bob. They sold CDS contracts to 10 other Bobs, all betting on the same loan of John. So if John repaid, AIG earned $100,000 from 10 Bobs. But if John defaulted, AIG had to pay all 10 of them, a total of $100,000. Now it sounds like pure gambling, because most of these Bobs, the CDS buyer, didn't even own any CDO. Essentially, they weren't buying insurance for their own assets. They were purely betting. This turned the housing market into a gigantic casino. And when borrowers started defaulting, CDOs collapsed. CDS bets collapsed. And by 2008, the entire financial system collapsed by 4/5. Why does this keep happening? From cheap stocks in the 90s to viral cryptocurrencies. Today, the tools may change, but the psychology behind scams remains unchanged. People always want to believe in easy money, and scammers know exactly how to sell that dream. You might wonder, if we know these tricks, why haven't they stopped? The truth is, many scams exist in a gray area. They appear legal even though they feel wrong. For example, in many countries, politicians are not banned from trading stocks. They just need to disclose their trades. And if they were ever banned, they could just ask their spouse to buy the right stocks before the news is released. Clearly, that sounds like insider trading. But proving it on paper is far from easy. So how can you protect yourself? First, diversify your investments. That way, if a hot stock turns out to be a pump and dump scheme, you won't lose all your savings. Second, be cautious with sudden price spikes. If a company is genuinely doing well, like Nvidia, its stock soaring after strong earnings makes sense. But remember the cheap stocks from Belfort and viral cryptocurrencies. Today, if you can't explain why the price is rising, that's a red flag. Third, be wary of anything that sounds too good to be true. This is the trick behind risky loans. Videos are labeled Mac A, and nearly every scam in history. The truth is, if getting rich were really that easy, they would have kept the secret to themselves and wouldn't need your money at all. And perhaps the best advice comes from Warren Buffett. Learning from your own mistakes is good, but learning from others' mistakes is even better. In short, whether it's a broker trying to convince you to buy a hot stock, an insider using information you don't have, or an entire market built on false promises, they all operate the same way. First, they create excitement, so you feel like you have to join. Then they control what you see, or the number of shares you can buy. Finally, they sell and exit, while everyone else is still buying, and the remaining ordinary investors are left with worthless assets. If you want me to make more videos explaining topics like this, please like and subscribe. Thanks for watching. Goodbye.